Hello investors. It's been a good month for your portfolio. The market in fact has been down 3% almost for the month of Feb. However, your portfolio is more than 3% positive. So we have been able to create a 6% plus alpha. That means an outperformance. And this is very, very important for us because it, of course, one is repairs a little bit of underperformance that we had last year. But more importantly is that the changes we made to your portfolio, and we've been communicating to you regularly, are starting to work out. So let me tell you why it is working. It is not just one-off. We feel that a new trend has started. See, we are trend followers in the sense that our main strategy is to catch the underlying trend, and underlying trends last from 3 to 5 years. What happened in 2022 was that the trend that was moving, that whole quality, high quality stock kind of, stocks, they started underperforming and the market actually churned, and this happened globally. So this churn is always a time, it's like a train, which changes tracks. When it changes tracks, there is a little bit of discomfort, there is vibration, but changing the track is important because if you don't change the track, you are going to get derailed at some point in time. So 2022 for us is nothing but changing the track. Yes, it leads to a little bit of pain, a little bit of underperformance, but change the track we have to. Change the stocks in your portfolio we have to. Because when we do that, the journey beyond that is smooth. And what you're experiencing this month is nothing but that journey. So I feel that the trend has changed, and this is getting reflected in the massive outperformance we've had this month. So let me put it in a few numbers so you can really understand, and I really appreciate your patience for being with us in spite of the little toss and tumble of last year. But last year has been particularly difficult for most of us. So what you see on your screen is a slide. The heading is 5-year leaders become losers in 2022. So essentially what I'm trying to tell you is that the trends that were there, which were doing well for the last 5 years, actually were going through a lot of difficulty in 2022. So in the left column you see rank. Now we have curated 40 bespoke thematic indexes. This is not what the indexes that you see with the exchanges, but these are our own curated, and that is why you will find that they are great granular detail. So that is ranking. So we've, out of the 40, we've taken the top 10 in terms of performance for the last 5 years. Then you will find sectors, you will find IT mid-cap, digital, electronic components, chemicals. These are sector indices which nobody else has, but these are what we have created for our investors and helping us to analyze the trends and themes, because ultimately we are trend followers. Then in the blue heading, which with the green column below, you will find the 5-year CAGR between 2017 to 21, means how these sectors performed on a CAGR basis over the 5 years. And extreme right is how they performed in 2022. So what you will find that in 2017-21, the best performing, for example, IT mid-cap, digital, electronic components, most of them have 30% plus. But in 2022, you will find that all of them had negative returns. And massive negative returns. They underperformed the market big time. So this clearly shows you how leadership actually changed. The leaders became losers. And that is a point where naturally most fund managers are going to be there. Nobody can pick the bottom, but with the lag, there is a need to move out. So you will find that if you go to our portfolio a year or 2 years ago, you will find that we had this leadership. But interestingly, over the last 1 year, we have moved out of them and we have moved to new themes and trends, which I'll share with you later. So this really shows you that how the top 10 best performing 5-year performance sectors actually were among the worst performing for 2022. And that's why I say 2022 was a very challenging year. The next slide, I show you the opposite. How the worst performing sectors on a 5-year basis were actually the best performers for 2022. So when I talk about a trend changing, it is not just that the trend changed at the top, the trend also changed at the bottom. So in the ranking column, you will see 31 from 40. So I told you that we look at 40 sectors. I showed you the top 10 performing in the previous slide. These are the worst 10. So you will find right at the bottom is PSU banks. So PSU banks up to 2021 on a 5-year CAGR were minus 14%. Housing, defense, hotels, media, tires, autos. So you will find that these were laggards for the last 5 years. But lo behold, when you go to the extreme right, 2022 returns, you will see that how the best performing sectors was defense, which was up 82% in spite of having a negative 1% 5-year CAGR before that. PSU banks, 14%, the worst performing, the dog sector for the last 5 years was actually a 81% outperformance. So this really explains that why 2022 was challenging for us, because the trend totally changed. It became diametrically opposite. And for us, that meant obviously 2022 was a bit challenging in terms of returns. But more importantly, the important thing for us to do was to also realign, because trends were changing. And now in the next slide, I'll show you that where we are right now. So the 6% outperformance that you are seeing is a function of the churn and a function of your patience. You will find that our top holding today is electrical equipments, almost 14 to 15%. This sector was not there in our portfolio. And we have been able to build on it because the market is telling us that we are at the cusp or maybe at the start of an industrial revival. And this industrial revival is more in engineering, capital goods, infra and related places. So you can clearly see, chemicals was our top holding. We have bought it down. We exited 2 stocks. We still like 2 stocks, but we are without emotion. We are driven towards trends. We are driven towards returns for you. FMCG food. Now we are not in the personal care. Food, we have Varun Beverages, ITC. Very, very different from the FMCG as you understand it. Auto ancillaries. They are not your normal auto ancillaries, but they are all related to electrical mobility. Tube India, Schaeffler. These are all very, very new themes, and you will find how we've been able to recalibrate your portfolio, take it up there, and that is what is showing in the performance now. This is where the new trends are, and we feel that we are in the process, but we have done the major part of the cleanup and the navigation. You'll find sectors like defense, which is at number 8. We have a very high allocation towards defense. We have Hindustan Aeronauticals, Bharat Electricals. So you can see that how your portfolio also has changed the trend. Of course, there's always a lag because nobody knows perfection and we are followers. So there has been a bit of a lag, and that lag is, I feel, going to get very, very well filled up or compensated for in the year 2023. And I think this month is hopefully the first step in that direction. Of course, this was about the portfolio and the change in trend. The big 50-pound gorilla is where's the market going. And of course, this whole Adani saga, it's been really tough for the market. As I said, it's been down almost 3% plus for the month. Now, what you will see on your screen is the Nifty for the last 1 year. So essentially, you'll find it's been chopping around, went down, went up, chopped around. So net, it has been where it is. So there hasn't been much index gains really. There has been more of a churn. But you'll find that the horizontal black line is around 8100, which we think is a very key pivot. It had broken out above that and we really felt it was going to run away, but markets have been correcting. And from the vertical black arrow, the down pointing arrow, you'll see that this is when the Adani saga. So what we experienced in the last 1.5 months is a fallout of that. Global markets have been pretty good, but our markets have been particularly hurt due to this. There is a good side and a bad side. I personally think that the good side is that better the cat is out of the bag. Because if this thing got elongated, the systematic risk would have been massive. In spite of the fall, you will find that there is no systematic risk, in the sense no bank has imploded, no financial institution has imploded, and the market has corrected. But a 5 to 6% correction is not the end of the world. If this very thing had happened 10 years ago, I tell you the market would have been in down circuit. So even if we are able to, as I said in a pressure cooker, release a bit of the pressure without massive collateral damage, I think it's okay. So I personally am looking at 8100. Yes, till we don't cross that level, we are not going to have a runaway bull market. But as I have shown or explained to you that even in this phase of consolidation, the time to recalibrate the portfolio is important. And as and when we break out, we feel that these stocks can actually have leadership, and that could really help us to outperform. See, due to our style of investing, trend following, we have 3 to 4 good years, and then as the trend changes, because no trend is infinite, you do have a year of underperformance, recalibration, change, churn. And I think for us, 2022 was that. 23 would hopefully be a year of outperformance, a huge catch up, and I think that this could be a multi-year kind of trend, and that's the way we have recalibrated your portfolio. So on that note, I leave you for this month. Keep my fingers crossed for the next month, and see you later. Bye bye.